Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora and welcome back to Markets, Mystics and Mayhem. Can you believe it, JK? It's our last episode for the year. It's been really fun doing this podcast, talking to cool guys like you, Wilkie, and everything. But yeah, what a way to go out this year with Hamish Wilkinson back for round 2. He's back. We're talking currency. And this time, I promise we're going to keep us on track. We're going to go through all the crosses because last time we hardly got past the Kiwi-US cross. And if you put traders and strategists into one room, honestly, you just lose all track of time. So we've got 15 minutes. We've got 5 crosses to go through. So whether you're an exporter or importer into the UK or Europe more broadly or even Japan, stick around and I promise we'll cover all the key exchange rates. But it's been 3 months, Wilkie, since you've been back. We've written another FX Tactical. You've got it here in front of you. Show the good people at home.
Another one hot off the press.
Hot off the press.
Yep.
And the title for this one?
Keep calm and carry Kiwi.
Awesome. So why don't we start there? Why don't we start with the Kiwi? What are we thinking about where it's going? What are our projections for that one?
Thanks for having me, guys, back again. Well, probably it's best to sort of, I guess, maybe look backwards before we look forwards. And at our last, obviously, tactical piece that we wrote up, we obviously suggested that we thought the Kiwi was heading on its way down towards 59 cents when it was trading up towards 63 and a half, I think, I recall, actually, when we last spoke. So, things have played out pretty much as we expected. Probably the only sort of I guess curveball, I wouldn't call it a curveball, but sort of a surprise perhaps was obviously Trump running the presidency, and that really sort of has helped actually that move lower on the Kiwi as the dollar has benefited from, I guess, Trump trade type factors. Yeah,
Which is a strange one, right? I mean, Trump being re-elected, most foreigners would go, isn't that a bad thing? But the markets are taking it as like pro-growth, pro-business, and even pro-inflation. So
and
it has
US
been,
dollar,
very pro-US dollar. So which is interesting, right?
Yeah, I mean, I guess the major theme, and you know, I guess you could look at, the market's looking at it 2 ways, whether it's potentially inflationary. That's probably the main train of thought, that it's going to be inflationary for the US economy, and hence perhaps sort of we'll see the Fed not deliver as many rate cuts next year. And that kind of goes into sort of our theme for obviously this updated tactical piece, in terms of we're still expecting the Kiwi to trade lower, particularly in the first half of 2025. And really driven on obviously as Trump comes into power and early in the year, the theme that we're perhaps seeing from from November onwards continue. Obviously throw in another 50 basis points rate cut from the Reserve Bank in February, and then another 25, and potentially some more. Obviously that's what our core view is ahead of the market, and that's where we start to see that lower dollar continue to come through from a Kiwi dollar perspective.
Yeah, so Kiwi rates have fallen quite far, and they've fallen sort of below US rates. And we think that continues. So that rate differential is a key driver. Also, the outlook for commodity prices, I think, is a key one as well for us, which, you know, with a soft global economy, with a soft Chinese economy, our currencies are underperforming.
But it's next year, as we say, is a year of 2 halves. And we're talking about the first half of next year, how you might, lose a bit of flavour next year, but it's at second half when we see things kind of turning, right?
Yeah, it's, I guess, having that sort of putting your optimistic hat on really at the end of the day in terms of, your guys' views of further rate cuts to come from the Reserve Bank. Markets obviously starting to price that now, albeit, it's a little bit underpriced for the end of 2025. I think sort of when I last looked at sort of always pricing set around the sort of 3.2% mark, whereas, our view is that the ARB is in to at least deliver a 3% cash rate by the end of 25. And so once those rate cuts start to come through, in terms of the economic growth situation domestically, hopefully that sort of starts to provide a bit of a support to the currency. And then again, flipping offshore in terms of that US story, there is an argument that perhaps in terms of, I guess, the Trump policy is is that markets will pre-price, or price the worst before it even happens. And so, sort of a buy the rumour, sell the fact type situation, and potentially, as we head into the second half of 25, the Fed isn't able to continue to cut rates, whereas markets not really pricing aggressive rate cuts from the Fed at this point in time.
And, you can think of New Zealand as a commodity currency. You can think of the Canadian dollar and a lot of others, but the one that we're most interested in is the Aussie.
Yes.
So if Aussie Kiwi dollar does this, what's that Widowmaker cross doing?
Yeah, it's again, we've actually put a little special topic in this updated tactical, and it's sort of it's always a challenging one, trying to get the Kiwi Aussie in a direction. It doesn't move at all, and then it moves really, really quickly, and we're kind of waiting for that move. And we do think Kiwi Aussie is, as I've mentioned, is going lower. It just seems to be a bit of a waiting game going on there. Really, sort of from an interest rate differential perspective, as you talked about, JK, is it really should be lower. It should be sort of in the 88-cent mark in our view. But as per our special topic, we sort of discussed the factor of China in terms of hard commodity story, as you're suggesting, and perhaps the slowdown in construction in China, and perhaps in terms of the reduced demand for iron ore products out of Australia, we feel that is sort of holding back that Australian dollar strength. Well, Australian dollar is performing on a relative basis, but from a Kiwi Aussie perspective rather, that feels like that's just keeping the Aussie just held back a little bit in terms of Kiwi Aussie performance.
It would be nice to see that shoe drop, actually, because they're our second largest trading partner, and with a weaker Kiwi, that'll help our exports into Australia. It'll also help the tourism industry, get more Aussies over here. So, hopefully that does drop.
Yeah.
Next cross.
Let's go. Next cross. All right, let's go. NZD yen. What's our thoughts around there? They're kind of going against, the Bank of Japan's obviously going against the tide of central banks and hiking interest rates.
Yes.
How's that playing out in the currency world?
Yeah, I mean, it's happening in the Kiwi yen. It's been, if anyone's looked at the charts that we put in the tactical, you can sort of see some big movements when events occur. And, we perhaps expect that to sort of continue next year. I think the market now prices in it's just over another 40 basis points of rate hikes from the Bank of Japan in 2025. So it's only one and a bit at this point, but that's a lot for as we know from history. So, and the point is that, as you said, MJ, they're going the opposite direction. I think we've seen around I think we put in the note, a 175 basis point spread contraction in terms of both those cash rates over the last, they'll be correct, over the last few months. And in terms of that, you started to see that flow through from a Kiwi yen perspective, yeah.
Yeah, it's so interesting because they haven't had a cash rate above 0.5% since, I was looking at it, since 1995. So for lots of people, that's all they can kind of...
Were you born then?
Yeah. No, I actually wasn't. So it's quite interesting to see this quite a historic shift in their monetary policy and how that's all playing out in currency, obviously. But I guess, Kate, next cross, let's move over to Europe. Let's start with the UK. That cross, how's the Kiwi holding up? Again, start with central banks. So we're kind of taking a different approach if we're comparing the Reserve Bank to the Bank of England, who are taking more gradual approach in easing policy. Yeah,
the Bank of England seems to be a little bit more conservative in their view in terms of, I guess they have a little bit more of a worry around inflation pressures. And that sort of also, you sort of see that somewhat in Europe, albeit the growth situation in Europe is definitely a lot softer. But Bank of England recently, last week I think it was, they've come out and suggested that they are looking at around 100 basis points of easing for 2025. That will take their cash rate from a level of 475 down to 375. We have a announcement this week. And so, as a result of that, I mean, ultimately, if we end up at a cash rate of 3% by the end of next year, this same sort of theory is working against Kiwi sterling in terms of continued downward pressure there. It has started to come, seen some decent moves from the 50s down into the 45-cent area now. And that is now actually back to sort of Brexit lows. 10-year lows or so. And so, yeah, we'll probably continue to see some further softness in Kiwi sterling coming through.
Brexit, my God. Was that 10 years already? No, 2016. Yeah, I remember that being quite a volatile time. The UK got a double-notch downgrade on the back of that, so that was a lot of fun in currency space. So sterling got hammered during that period. But, yeah, so Kiwi weakness against sterling. What about euro?
Euro, yeah, as was sort of suggested. I guess the growth outlook in Europe, there's lots of factors going on there in terms of obviously soft demand out of China for German cars. Obviously, the concern around the tariff situation in the US, because potentially Europe will probably be one of the largest impacted economies that you'll see, and I guess fundamentals around the European economy, right? Sort of have been in the doldrums for quite a period of time, and so the ECB is looking at continued cuts, and market implies sort of a ECB cash rate again by the end of next year of sort of 1.75%. And so, that takes obviously, that's probably one cross in terms of a Kiwi perspective, is that so we do find that actually there should find some sort of support and potentially at least hold the current levels that we're at, and if not trade a touch higher as a result of that soft outlook in Europe.
We've got 11 minutes.
You're doing well.
We're doing pretty well. We're moving along. I think those are all the currencies we actually covered in the FX tactical. This has given me an opportunity to throw you a good one.
All right.
Okay, let me think. Say I've got a trip to Mexico next year.
Where's the peso?
Where is the peso going next year? Come on, I need some good news. Is it going to be?
Well, it's certainly under pressure because of where's Menica when I need it? It's certainly under pressure in terms of its obviously what's going on in the US. Kiwi peso, we don't trade a lot of Kiwi peso actually, funny enough, in our dealing room. But yeah, because of, I would argue, relatively neutral downside peso in terms of Trump and his policy, downside Kiwi, but perhaps Kiwi outperforming the peso a little bit. So your trip to Mexico,
pretty expensive.
No, well, it'll be expensive, but perhaps not so bad. Yeah, that's what you're thinking.
Zimbabwean dollar.
Oh, this is getting out of control now.
Yeah, very good. I guess what are your main messages if you're sitting here looking to next year? You've just read the Kiwibank outlook, nudge, and it's a game of two halves. What do you recommend to clients? Like, I mean, they're sitting there. There's some downside risk to the Kiwi, but over the second half of the year, there's some upside risk. You're an importer, you're an exporter. I mean, what's the key message? Is it just talk to your banker?
Yeah,
try and hedge early.
I mean, I guess again, if I reflect on the last three or so months, and perhaps the last six or so months, is in terms of, from a currency perspective, as the currency has come lower, we've noticed actually a lot of importers actually haven't been that active, and you think they would be in terms of this current, as the currency falls, you tend to want it to be hedge your risk. But I also suspect it's a factor of the domestic economies and in terms of the domestic demand situation. They've, through that COVID period, importers were so struggling in the terms of keeping up with supply. They just continue to import and chasing supply and paying, obviously, and that's obviously part of the the inflation problem that we saw as a result of that. And then it's sort of just screeched to a halt, probably 18 or so months ago, as obviously rates went higher and the domestic demand story fell apart. So, yeah, it's an interesting one right here, right now. How do they react to it? They certainly haven't been. I don't think they're stocking up as much as they were back in those times. And so now, it will be sort of as hopefully the lower rate story comes through and we do start to see a recovery in domestic consumption measures as such, those importers will end up being able to import more stock. But I think it's more of the second half of next year for the importer. Yeah, obviously as per our tactical. Yeah. So yeah, in terms of how you'd approach it is just maintaining stock levels, not being too long in your hedge profile, and then hopefully our view comes through for the second half of next year and you can pick up some better cover out there. Obviously, it's the flip side of the story for the exporter, right? So they've actually had pretty good cover, and as the currencies come down, because we've had a couple of goes down here now, and so as the currencies come down, again for the last 3 or so months, we actually haven't seen a hell of a lot of activity And that's really, again, because of they've had good cover levels, and now they're probably waiting to sort of see 57s, 56s and 55s to really sort of ramp up their hedging profiles. And clearly, as our view is, if we see it sort of bottoming out that sort of area, that's when we would probably suggest to sort of really start to look at sort of a longer term hedging approach.
Yeah. It's actually good news almost both ways, right? So it's Kiwi's falling now, which is going to help our exporters, which is going to help the recovery. And then in the second half of next year, we're expecting the consumer to return, which you've noted in your new retail note spending tracker. That was really good. And then like the currency will start to lift as importers will probably have more demand, right? It could be quite an interesting.
Isn't that what economics is all about? Floating interest rates, exchange rates rather. So yeah.
Exactly.
Yeah.
No, yeah, second half of next year, I think it's looking pretty positive in terms of the outlook and that turning point. Mystics is part of the name of the game, so we're trying to pick those turning points, and it looks like the second half of the year, next year will be that point, because we've had it pretty tough, and I think we're ending the cycle now. Yeah. Consumer will return, housing market should be better, and all of that just gets reflected in currency with a stronger Kiwi getting, catching a bid and all that stuff. So. One question before we do wrap up. We talk about a Goldilocks neutral rate. Is there sort of a Goldilocks currency for where exporters and importers are kind of both happy?
I get asked this question lots.
Yes.
And everyone says it's 65 cents.
Yes.
I have a different view. I'd say it's a range, and then again, it depends on where the economy is. And then at the moment, we're actually probably in a Goldilocks state for helping the recovery from an export-driven perspective. So I would probably argue it's a 60 to 70 cent range, and we're obviously down the south side of that area right now. So there's my on the fence for you.
Yeah.
Well, a 10 cent range is actually a little narrow for what the Kiwi normally trades in. So thanks for honing in.
But ultimately, I think next year it's time to perhaps be a bit more positive about things. It's as you said, second half of next year, time to get going, right? So hopefully it's going to be good, and the currency will reflect that. So
yeah.
That's certainly what we've been telling our clients, right? It's been a tough 2 years, as you said. We're looking to next year with a bit more optimism, and that will compound, and it will grow, and it will lead to better outcomes as we head into 2026. But there's still a bit of a waiting game for many businesses and households as these rate cuts come through. I think we're done. That was great. Thanks for coming on again. Wilkie, we really appreciate your, first of all, your input into the tactical piece, which we love publishing with you guys, you and Menaka. And we'll do it again probably in another 3 months. See where we're at. See if we are actually at 55 cents.
Yeah. 2 in a row, maybe.
Yeah, exactly. All right, that's it from us. Thank you. Please like, subscribe, forward to your friends, and we'll speak to you in a couple of weeks. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.